You have $1,000. Maybe it's a bonus, a tax refund, or savings you finally pulled together. The question is, what do you do with it? $1,000 won't buy you a beach house. But, invested wisely, it can be the seed of something much, much larger. Here's the math. $1,000 at 7% average annual return grows to over $4,300 in 20 years, without you adding a single extra dollar. Today, I'll show you the 6 best places to put $1,000 in 2026, with a concrete example of exactly how to split it. Let's go. Before you put a single dollar into any market, 2 non-negotiables. First, pay off any high-interest debt. A credit card charging 20% APR is a guaranteed negative 20% return. No investment beats that consistently. Second, make sure you have a 3-month emergency fund in cash before investing. Markets are honest, but they're never punctual. Don't invest money you might need in the next 12 months. Option 1. Index funds and ETFs. This is Warren Buffett's favorite for a reason. One purchase gives you exposure to hundreds of companies at once, like the S&P 500's 500 largest U.S. businesses, with some of the lowest fees in the industry. Option 2. A high-yield savings account or short-term treasury bills. In 2026, these are still offering around 4% interest with zero risk to your principal. Not exciting, but smart. Think of it as a staging area while the rest of your money works harder. Option 3. AI and tech sector ETFs. Artificial intelligence has moved from hype to infrastructure. Chip makers, cloud providers, data companies, the picks and shovels of the AI era, are seeing durable, structural demand. A sector ETF lets you ride the wave without betting everything on one company. Option 4. Invest in yourself. This might be the most underrated move on this list. A $500 course, certification, or skill upgrade can raise your earning potential immediately, and that compounding starts right away, not 20 years from now. Option 5. Real estate investment trusts, REITs. You can't buy a building with $1,000, but you can own a slice of one. REITs trade like stocks, and many pay quarterly dividends, giving you real estate exposure without the mortgage. Option 6. Crypto, with strict limits. Bitcoin and Ethereum have matured, but this is still speculative territory with serious volatility. If you choose to allocate here, treat it as a high-risk satellite, never more than 5 to 10% of your portfolio. Only bet what you can afford to lose entirely. So here's what a balanced, growth-oriented $1,000 portfolio looks like in 2026. Total Market Index Fund, $400. That's your bedrock. 40 years of track record behind it. International Stocks, $150. Geographic Spread and Currency Diversification. AI and Tech ETF, $150. Targeted Sector Exposure. REIT, $100. Real Estate plus Dividends. High Yield Savings, $150. Liquidity Buffer, still earning over 4%. And the final optional slice, $50 in crypto, capped, intentional, and fully prepared to lose. That's your $1,000, fully deployed, properly diversified, ready for 2026. Here's the truth that makes all of this worth doing. Compound interest doesn't care about your income, your background, or where you grew up. It cares about one thing only: time. $1,000 invested for 20 years at 7% average return becomes $4,322 without adding a single extra dollar. Add just $83 a month on top of that, and you're looking at over $50,000. That's the engine: time and consistency. 3 golden rules before we wrap up. Rule 1. Use tax-advantaged accounts wherever possible. In the US, that's a Roth IRA or 401k. In the UK, an ISA. Free tax benefits from your government are the closest thing to free money in investing. Rule 2. Automate everything. Set up a recurring monthly investment, even $83 a month. What you never see, you never miss. And what you never miss quietly becomes wealth. Rule 3. Ignore the daily noise. Don't check your portfolio every day. Volatility is the price of admission for long-term gains. The investors who panic and sell at the bottom are the ones who lose. The ones who stay the course win. The most important investment decision you'll make today isn't which fund to pick. It's the decision to start. The best time was yesterday. The second best time is right now, even if right now only means $1,000. Quick recap. 6 options for your $1,000. Index funds for the bedrock, high-yield savings as your buffer, AI and tech ETFs for growth exposure, investing in yourself, REITs for real estate income, and a tiny crypto slice if you want the upside. Pay off high-interest debt first. Keep 3 months of expenses in cash. Use tax-advantaged accounts. Automate your investments. And ignore the daily noise. You don't need perfect market timing. You don't need a finance degree. You just need a plan and the discipline to stick with it. If this video helped, hit like, subscribe, and drop your answer in the comments. Which of the 6 options are you most excited to start with? I read every single one. See you next time!